introduce myself and Altfest, and then we're going to talk to you about financial planning for physicians across the life cycle with the hope and expectation that you're going to learn a few things that will be helpful to you as you manage your finances. So I'm Andrew Altfest. I'm the president and a principal advisor of Altfest Personal Wealth Management. Altfest, we've just celebrated our 41st year of being in business. We had a nice event in Manhattan a couple of days ago where we brought our clients and friends of the firm and this team together and had over 100 people together celebrating our 41st anniversary. And had some good education that night too. We manage about $1.7 billion in total for all of our clients. And we're a fee-only firm. So what does that mean, fee only? Well, it means that we just charge a transparent fee for service. And we don't sell any products. We don't sell insurance products. We don't sell banking products. We don't sell investment products. We advise our clients and on all of these, all their planning matters, but our physician clients really like that we do not have an axe to grind. You don't have to worry that we're giving you advice about doing something financially we're only telling you that because it's going to make more compensation for us. That's not, we just charge a transparent fee for service, so we remove that conflict of interest. We're on the Barron's Hall of Fame list. That's arguably the greatest distinction for financial advisors. Barron's publication ranks the top advisors in the country. For independent advisors like Altfest, top RA firms, we're on a national list of the top 100 and have been made the Hall of Fame list by being on that list for over 10 times. We specialize in working with physicians, and so we have worked with physicians for many, many years. It's our largest client profession that we work with by far. And at Altfest, we have a total of 40 employees. So we're a small firm, but one with resources. We're small enough where we get to know all of our clients very well, and but at the same time, we have deep expertise in investments, people who just focus on investments, people who have a tax background. We have a number of CPAs at our firm. We have an in-house estate attorney. We have people with insurance backgrounds. Again, we don't sell insurance, but we help clients with it. So we have a lot of great expertise, and that's really important to our physician clients, is to help with not just their portfolio, do a good job there, but also help with all of their other planning issues, and we'll be talking about some of those tonight. We also have a long history in partnering with medical associations to work with their members, and so we are the preferred wealth manager for the Medical Society of the State of New York for their members, for New York ACS, for the PA Med, for Miami Med, and for others as well. So we are used to providing a lot of content, a lot of education for physicians, and for gaining the trust of very large medical associations to be a strong partner for their members. Okay, so that's a little bit about Altfest and the work we do for physicians. Now I want to talk about the life cycle, physician financial planning life cycle. Everyone is different. So when you talk about the life cycle, we're going to talk about common things that we see when we work with many clients. But keep in mind, what makes our work fun and stimulating is really getting to know what's important to everyone that we work with. In preparation for this talk tonight, I was thinking about longtime clients that I work with, and they've been clients of Altfest since the early 90s. And the Husband has a medical practice. He's a physician, and his wife manages the medical practice. And not long ago, we met with them and we went over their finances. And I had good news to share. I told them that they are overfunded for retirement and they should go and spend more money. They should go and enjoy themselves. They should go and consider buying a second home. They should not take work so seriously because they don't need to work. And I thought for this talk about, well, what allowed them to be successful? What led to their success financially? And going all the way back to when they started with us as early career physicians. And there was a lot of planning over time. When they first opened the practice, we helped them set up the retirement plan for their practice. We helped them set up a profit sharing plan. And there was a lot of saving and disciplined saving and smart investing that happened over many years. We over time we talked to them about their estate planning. We helped them with their estate plan and leaving money to what helped them think through what is the best way to leave money to their children. Should it be done outright? Should it be left in trust? We help them plan for state estate taxes, and that gets more complicated when when your wealth grows within your tax qualified retirement plan. We help them plan for their insurance, and we help them make the most out of their benefits through their hospital. They even though they have their own practice, they also work part-time, or the physician works part-time at the hospital. And so we help them make the most of the benefits they had available to them. We helped them through when there was a patient lawsuit scare, that we won't talk about the merits of that case, but unfortunately, there was a patient lawsuit scare that kept them up at night. And we went over their finances and strategies to best protect themselves against patient lawsuits. And now we're helping them with the sale of their practice to get as much out of the value of their practice as they can as they sell it and retire. So you can see that there's a lot of planning that gets done over time, and that collaborative relationship has led to their financial success. Now, if we talk about what are some of the issues that are usually top of mind for physicians at different points in their life cycle, financial planning starts as a resident. And, as a really early career physician, often we're talking to our early career physicians about what are the best ways to save and to think about how to pay down their debt, and then also how to, at the same time, save for different goals that they have, such as buying a first home. And while keeping in mind long-term goals that they have that seem very far off, but they have a very strong advantage to start planning for, such as retirement. So it's a combination, thinking through cash flow planning, thinking about strategies to best optimize the student debt, if there is any, but often there can be. Then when we get to an attending physician, we're thinking about at that time things like how best to invest money. This is where we start seeing an investment portfolio, and we're thinking about how to invest that money according to the physician's goals, what accounts to utilize to invest that money, thinking about different traditional 403B or 401k, depending on what's available, or a Roth version. And then when we get to a mid-career physician, often we'll see a family that is in place, and we want to think about estate planning for a younger family. So we're thinking about making sure that, God forbid, if the physician and spouse are not there, who's going to take care of the children? Also, life insurance, how making sure that if earnings are not, God forbid, earnings aren't there, the physician's not there, and therefore the spigot is shut off. How is the family going to be taken care of? And then when we think about planning for a physician before retirement, often we're talking at that point about retirement planning. It's gotten close. You can see it. You can start to think about it, and it's the kind of thing that we want to that the physician has top of mind. I can think of a physician that I work with, and he's reducing his hours now. He's reducing his shifts, and his hours are decreasing, and the time that his goal is to spend more time on his hobbies. He loves playing the guitar and he loves gardening. So he tells me I'm reducing my hours practicing, and I'm increasing the hours that I spend playing the guitar in a band and gardening as well. So at this point, we're starting to think more closely about what the physician can spend in retirement comfortably. How many more years do you need to work? What can you spend without having real risk of running out of money? So we're doing probability analysis in retirement planning, running different scenarios that vary the age, the investment returns, the rates of inflation, to make sure that there's minimal risk of outliving your assets. And this is also where strategies come into play, strategies that you can take advantage of. You can do some really interesting things like plan to reduce your taxes because you're earning more today than you will in the future when you retire, and you can take advantage of that big difference between your higher tax rate today, higher income, higher tax rate today, and a lower income tax rate in the future. And then when we talk about retirement, helping physicians who are retired, we're thinking more about things like how best to live off of the assets that you currently have, what assets to touch, what assets to tap to fund your expenses. And we're thinking about the portfolio as well. Should the portfolio be made to be more conservative, to be more income oriented, or should we keep it on growth to focus on making sure that there are enough funds to last for a lifetime that could be decades to come. So Jesse, I'm now going to turn it over to Jesse, who's going to talk more about specific strategies that we apply and help physicians work through.
Yeah, thanks so much, Andrew. And that was a great overview of the life cycle. And we work with a lot of physicians, as Andrew mentioned, at all different stages of their lives and careers. One of the most common questions that we get from our physician clients is, no matter what stage of their career they're in, early career, mid-career, just before retirement, is, am I on track for retirement? Or put another way, how soon can I be financially independent? And it makes sense that we get this question so often. I mean, very few people, very few new clients who come to us know where they stand or how to get where they want to be. And a similar question that we get is, how much money do I need to have saved in order to retire comfortably? I'll share an example as well. We have a client who we began working with last year, a married couple, both physicians, in their late 70s. The husband recently retired, so very long working career, and his wife is actually still working in private practice. So both have had very long and successful careers. They've done a great job saving. They've accumulated a portfolio of $18 million, and it's a large portfolio that they've accumulated, but their expenses are also very high. And to be fair, a lot of it is discretionary expenses that they have. The husband's very charitably inclined. He's made very large donations to a vehicle called a donor advised fund, which is a very helpful vehicle that allows you to make charitable donations in a very tax efficient way, helps reduce your tax bill. Andrew's going to speak a little bit more about this later on. He's also put a lot of money into 529 college savings accounts for their grandchildren, and he's helped his own children out financially through what are called intra-family loans to help his two sons. So this couple that we work with are very generous. They give a lot to charity in their family, and so their expenses per their preferences are high, and they also have a lot of their portfolio in pre-tax retirement accounts that will be taxed at their ordinary income rate when they pull the money out. And this is something that we see a lot with retired physicians who are in high tax brackets throughout their careers, and they're doing their best to maximize their tax deductible savings through their 403b plans and 401k plans and 457 plans, if you're eligible, and to allow for the greatest amount of tax deductible savings. Now when you pull the money out, as I mentioned, that money is going to be taxable. And so our client was really worried about the taxes that they will owe once they have to start drawing down these accounts. And they are of the age where the IRS forces you to take what are called required minimum distributions. And these required distributions increase every single year. So prior to working with us, our client, he did his own retirement analysis, which basically showed that the only way that he and his wife are going to be able to retire comfortably and make it through and make sure they didn't outlive their assets was to go back to living like a resident. That's what he told us, and that it was only going to be rice and beans for dinner from here on out. No spending whatsoever beyond the basics. And again, keep in mind they have an $18 million portfolio. It's not the level of assets where you'd think they'd be worried about something like that. And when they first came to us, his wife, who was begging us, she was telling us, "Please tell me my husband is wrong about this. Tell us we'll be okay." And what we said we'll do, and what we did was we created a comprehensive retirement plan for them. And it turns out she was right. Her husband was wrong. They could afford to do every single thing that they wanted to do with their money, still be as charitably inclined as they want, still give money to their family members, and live a comfortable lifestyle, and still have an extremely low chance of running out of money. So there might have been some flaws in his initial analysis, but the point here is that being overly frugal isn't ideal either. We're not the budget police for our clients. We want to help you live the lives that you want to live and enjoy the retirement that you deserve. And being overly frugal when you don't have to be also isn't ideal, because you might feel less happy or less fulfilled. And so this is really where we come in and help our clients by understanding their situations, what they have to work with, and what they're trying to accomplish, and advising them on how to best make that last and help achieve their goals and how they want to live. So let's take a deeper look at some of those key factors that make this retirement readiness question more difficult to answer, right? It depends. So one unknown, you could see here, we don't know how long we will live, right? Another unknown is that we don't know how inflation will affect our spending power over time. And we also don't know how our investments are going to perform. No one has a crystal ball, and we can't know the answers to these questions. So, the reason why retirement planning, we find with our clients, provides such peace of mind for them is because we are able to analyze a range of potential outcomes. As Andrew mentioned, we model a wide array of different inflation and investment return assumptions to stress test our clients' plans and give them a very high degree of confidence in the success of their plan. And it's also important to note that because we are making projections and looking at multiple different scenarios, it's important to continuously assess your retirement readiness, or if you're already retired, continue to assess your plan to make sure that you're still on track. It's not a one and done exercise where you create a plan, you put it on a shelf, and you don't look at it again, because there are external factors like inflation, like market conditions that affect the returns of your portfolio that can really alter the course of your plan, as can changes in your personal circumstances. So it's important to continue to revisit your plan. And so, as I mentioned a moment ago, right, another issue is that we don't know how long we're going to live. And the retired physician who I mentioned the story about a moment ago asked us, "What happens now if I live to 100, or what happens to I live until 110? I'm already 79 years old," and it's a fair question. Certainly, the older you get, obviously, the more likely it is that you're going to reach those later years in life. And so, what this chart is showing here is that if you're 65 years old today, there's a 1 in 5 chance, 20% chance that at least you or your spouse will live until age 95. So, although it's not the likely scenario, it's certainly possible. And we think it's very important to have a financial plan in which you have confidence that there's a very strong likelihood that your assets will be able to support you at least into your late 90s. Now let's talk about inflation, much more top of mind today, right, than it was a few years ago when inflation was much lower. And we also know, right, what things used. We're aware of inflation, right? We know what things used to cost decades ago and what they cost today, and what a big difference it is. But still, many people don't consider inflation when planning for retirement. Now it's not so much the headline number, like the current headline number that matters, but it's rather the effects of inflation over a 25 or 30-year retirement for many people, or if you retire earlier, the time horizon could be even longer than that. So you want to have a sense of how inflation will impact your purchasing power. And what you can see here is that even just 3% annualized inflation would cut your spending power in half over the course of a 25-year period. If you increase that to 5% annualized inflation, your purchasing power would go down by more than 2/3. So it's a meaningful spending power reduction. Inflation is powerful when compounded over a long period of time. And why does this matter? Well, it matters because many people, when they first come to us, will say essentially that they've heard that, as we get closer to retirement, we should move all of our investments into very conservative vehicles like bonds or cash. And we see a lot of people who are meeting for the first time who have a substantial amount of cash, pure cash in their portfolio. And although it is true today that money market funds are giving you much better returns than they were a few years ago. You can get 5% or so, or thereabouts, in a money market fund today, which is a lot better than in recent history. But it's also important to keep in mind that those returns are not fixed forever. Those returns will fluctuate with interest rates over time as they go up and down. And the reality is that for most people, bonds and cash alone are unlikely to generate the returns that you need to beat inflation and allow you to really enjoy the retirement that you deserve. The problem here is that there's a huge psychological factor that prevents people from investing their cash. People will wonder, what if the market goes down as soon as I start investing? Studies certainly show that people feel losses, economic losses, much more so than they feel good about gains in their investment portfolio. But if you look at history, the data tells us that it's very important to stay invested and stick to the course. So what this slide is showing is that trying to time the market and picking the exact moment to put cash to work is very, very difficult. Um, and if you get it wrong, it can be really detrimental to your long-term returns. So what you can see here is that from the 20-year period from 2003 to 2023, if you miss just the 5 best days in the S&P 500 and general US benchmark, missing the 5 best days in the market over 20 years would have reduced your returns by 37%. If you missed the 25 best days over that period, your returns would have been reduced by 78%. A shocking statistic, but really highlights the importance of staying invested. Now, it's true. moving on here, in any one year, investment returns can certainly vary widely, and we've probably all experienced that. We just went through, feels like yesterday, 4 years ago now, the start of the pandemic, in which the S&P dropped substantially and then subsequently rebounded very quickly. But as you look over longer periods of time, you can see there that very quickly there starts to be a much narrower range of returns and outcomes. And so, for example, here, if you look at if you look at a diversified portfolio of 60% stocks and 40% bonds, which are the gray columns here shown on the chart, since 1950, there has never been a rolling 5-year period where that portfolio has experienced a negative return. So the takeaway is that if you're in a position where you're going to be relying on your portfolio to meet your needs over a long period of time, like retirement, which can again be 30 or more years for many people, it's important to stay invested. We also recommend looking outside of just traditional stocks and bonds to enhance your portfolio's diversification. And we encourage our clients to consider alternative investments. Now, when I say alternatives, it can include a lot of different types of investments. A few examples, though, are real estate, infrastructure investments, and also private equity, just to name a few examples. Historically, alternative investments have been shown to add to your portfolio's returns, which you can see on the y-axis here, while reducing the level of volatility in your portfolio, which you can see on the x-axis. 2022 was a great example, just a great one great recent example of how alternatives can be really beneficial, because in 2022, as many on the call may remember, a spike in interest rates and inflation caused both stocks and bonds to decline almost in lockstep. And alternatives were proved to be a very important hedge, and certainly were for our clients' portfolios. So we think it's very important, especially in uncertain environments, to incorporate alternatives into the portfolio when possible. But we do highly recommend that when you're dealing with, just like with any investment strategy, stocks, bonds, alternatives, it's important to work with a professional to build a diversified portfolio, rather than putting all your eggs in sort of one or two alternative investments. So how do you evaluate, with all of that said, how do you evaluate where you stand today, and in terms of whether you're early in your career, your mid-career, or you're just before retirement, and you want to make sure that you can have confidence in being financially independent? Well, there's a few main elements. You want to make sure that you have a good understanding of your inflows. What are your Social Security benefits projected to be? Will you receive any pension benefits? What level of income could your investments that you've accumulated so far provide for you? And then you should look at your outflows. Like, what are your expenses? What are your medical expenses going to be? Importantly, we actually inflate medical expenses at a higher rate than other expenses, because they historically have grown at a faster rate than the national rate of inflation. What if you need long-term care that's not covered by insurance? This can be a six-figure expense that many people don't anticipate. Are you going to buy some form of insurance to cover that risk, or do you have the assets to self-fund from the assets that you've accumulated? And then what are your aspirations? What do you want? What kind of lifestyle do you want to live? Do you want to travel a lot? Do you want to buy that second home, as Andrew it was encouraging his clients to consider, because that they wanted to do that? Do you want to set aside money for your children or your grandchildren? And another outflow that we all, I think, equally don't like is what's your tax situation going to be? Are you going to be dealing with those large required minimum distributions like the client I mentioned, or can you hopefully reduce those taxes by being proactive and looking at Roth conversions early on in your retirement? Andrew's going to speak about that in a little bit. If you have non-retirement accounts, can you reduce your taxable income with things like municipal bonds, where the interest is tax-free? We happen to think municipal bonds, particularly in New York, are a really compelling opportunity today. And then what is your time horizon? Are you retiring early? Are you going to do a phased retirement where you continue to work part-time? Many of our physician clients end up teaching in some capacity or continuing to work in some capacity. And then once again, making sure that from a longevity standpoint, that your financial plan is assuming that you're living at least into your late 90s. But as I mentioned, we can adjust that for each of our client situations. So in summary, we really want to understand our client situations holistically, capture all the pieces, make sure that we have realistic expectations for investment returns and inflation, and account for the unknown. And I'll just mention expenses. No understanding what you're spending is one of the toughest things that we find with our clients. This is a snapshot of our financial planning software we use to help our clients get a really good handle on their budget. This is an example where you can see someone actually linked their credit card to our financial portal just to see the spending data, so that they can have a really good understanding of how they're spending their money, and so that we can build the most comprehensive plan for them. I'll touch again upon an important part about diversification within your investment portfolio. Today, without knowing it, I think many people, because of how big of a component, for example, that technology stocks have become as part of major market indices like the S&P 500, people have a lot of exposure to that area, and it's important to keep that in mind, because if you get a pullback in that one sector of the market, you think all the way back to 2000 when the NASDAQ crashed, that affected obviously the technology sector more so than anything else. That your portfolio is going to be subject to that additional volatility. And you really want to make sure that you maintain good diversification, particularly as you get closer and closer to retirement. And again, as Andrew is mentioning, once again, this statistical analysis that we're running to stress test our clients' portfolios and making sure that even in a worst case scenario where you have investment returns that are much lower than you would expect, or inflation that is much higher than you would expect, or both, that even in that scenario, you would still expect your assets to be able to support you throughout your lifetime. So I hope this was a helpful overview of how we think about retirement, with some real live examples from our clients. And I'll turn it back over to Andrew now to talk about some additional important financial planning areas that tie into a comprehensive financial plan, including taxes and risk management and estate planning.
Thanks very much, Jesse. So tax planning, this is a great topic, and I think one that our physicians, clients that we work with, they care a lot about. How to keep Uncle Sam from out of your pocket as much as possible. So tax planning is very specific to your circumstances. You could own a lot of real estate, for example. You have a spouse who is a business owner. Whatever your circumstance may be, you need a specific plan. But we're going to talk about some planning strategies that affect many of our physician clients. The first is retirement plans, the tax qualified retirement plan that you have available to you, making sure that you're taking advantage of that. And the planning opportunities have become greater through these plans. The way you can see a tax qualified retirement plan, it's a favorable loan from the government. You don't have to pay taxes today by contributing to these plans, and you get to defer the tax and grow your wealth in your retirement plans and compound that wealth for many years until you finally have to take money out of the plan and pay the government. Usually, for most of us, it will be age 75 when you have to start taking money out. You'll have a 401k or 403b plan available to you. You'll have often we see Roth options, Roth 401k or 403b. You can put in $23,000 into these plans today. Your employer is likely making a contribution for you as well. And then if you're over 50, then you can put in another $7,500. There's also what's called a 457B plan that if you work at a hospital, you could very well have a 457B plan available to you. This is something special that the average employee of a corporation does not have. This is for a nonprofit to be able to offer to its higher earning certain population, like their higher earning employees. And you can put in even more money, tax deferred to retirement. You can put in up to another $23,000 for your retirement, in addition to what's in the 401k or 403b plan. Now the 457, there are some things to think about with this plan. You, unlike the 401k plan, if your hospital goes under, you will be a general creditor. And so we and our physician clients like to look at the financial strength of the hospital before contributing money to it and monitor the financial strength of the hospital. But often people gain confidence in the financial strength of their hospital, and this can be a good plan to contribute to. Sometime if you're going to be contributing for 1 year, and then let's say I'm working today at the hospital and I'm planning on moving to another state and changing jobs. This you may need to take the money out of the plan after you leave employment. And so if you put money into the plan for 1 year and then you have to take money out the next year, you could actually be placed into a higher tax bracket through this plan, because then you've deferred income for a short period of time, let's say 1 year or a few years, and then you have to take it all out in a lump sum, and then you actually have to pay more tax, and that can have to pay more tax in that situation. I did see that happen once to a physician before we worked with him. He put money into the plan and then he left. His hospital got pushed into a higher tax bracket. So this is most appropriate for you if you're planning on 457B plan, if you're planning on working at the hospital for a longer period of time, or you're going to be retiring and you could very well be in a lower tax bracket after you leave the hospital, and therefore will have paid less and deferred taxes in a high tax environment and taken money in a lower tax environment. Now, why is a health savings account here on the left? Isn't that for health expenses? Well, yes, it is for health expenses, but it also serves another purpose, which it could be a great retirement savings vehicle. It could be the best retirement vehicle that you have available to you, excluding the employer contribution that you get, the free money you get from your employer. This could be a vehicle that is better because it's triple tax free. You put money into the account. You don't have to pay taxes when you shield yourself from the taxes. You don't have to pay taxes on those contributions, and the money grows tax free in the account. And then when you pull it out, as long as it's for qualified expenses, you don't pay tax at that time either. So it's triple tax free. You can put 4150 into that account as a single now this year. If you're doing it for a family, if you're contributing for a family, if you have a family on the plan, $8,300 is what you can put in. And there's also actually a catch-up contribution that's allowed over age 55. So this can add up over time to a meaningful tax savings, and you want to invest this money and grow it. Now, if you have a private practice, you have more options available to you. You can choose between plans like a simple plan and a SEP plan, SEP IRA. You can choose between a profit sharing plan and a 401k combination, or a defined benefit plan. There's often ways to save even more money. And so a profit sharing plan allows you to contribute more than a SEP or simple, and a defined benefit pension plan can be a great vehicle, particularly for older physicians as you get older. And if you have the right demographic, you have a practice in which younger, lower paid people work at the practice, then the amount of benefit that you get for yourself that you can contribute tax deferred can be significant, and the expense for doing so by giving contributions to others who work for you, could be that contribution to others might be low in comparison to what it is for you. And you can create a lot of wealth over time by making very large contributions, and even employing your spouse and your children in some cases. So there's very rich opportunities available to private practice owners. Now, a Roth conversion, we're spending some time on this. A Roth conversion may make sense for you today. Even if it doesn't, my bet is that it will make sense for you at some point over your lifetime. A Roth conversion is simply taking an IRA that has pre-tax money in it and converting it to a Roth IRA. Now, why would you do that? Well, a pre-tax IRA, you have to take money out starting for most people at age 75. A Roth, you never have to take money out. The government gets paid today on the conversion from the IRA to a Roth, and then the money grows tax-free in the account forever, and then you never have to take it out. And some people don't take it out and they pass it to their heirs, and then their heirs get a benefit from the account. Let me give you an illustration about how this could be a very valuable savings vehicle to convert a Roth IRA and a conversion to a Roth IRA. Here's an illustration that we did for someone who is converting $100,000. You have to look at your current tax bracket. You have to look at make assumptions around investment growth, and then we do an analysis that shows a projected break even when a Roth IRA and converting to a Roth IRA will have produced more wealth than keeping it all in a traditional IRA. And here you see at age 84, there is the break even. And this is over the lifespan of the physician, as opposed to factoring in an even greater benefit, which would have been factoring in if we looked at estate planning for the next generation, because this money will produce a benefit to heirs as well. So in this example, converting $100,000 IRA to a Roth produces another $189,000 of wealth over the projected wealth over the physician's lifespan. Now, getting money into a Roth account, one way of doing it is to convert to a Roth. There are other ways of doing it. And for many of our physician clients, they make too much money to be able to make a traditional Roth IRA contribution, which phases out at higher levels of income. But you can put money into a Roth by making what's called a backdoor Roth IRA contribution, in which you open an IRA account, make a non-deductible IRA contribution, and then you immediately convert it to a Roth IRA. And you can do that. Someone who makes $2 billion a year can make a non-deductible IRA contribution. There's no income limitations. And then everyone can convert it to a Roth. So you are able to get it to a Roth that way. The only thing you have to keep in mind that we raise awareness to is if you have other IRA assets, then you will be partially taxed on that conversion. So it works best if you don't have other IRA assets. You can also, another neat planning technique is called a mega backdoor Roth contribution. So you have a Roth contribution, then you have a mega backdoor Roth contribution. Doesn't that sound cool? A mega backdoor Roth contribution is done by making after-tax contributions to your employer retirement account. So we talked about how you can make $23,000 of contributions this year to your 401k, 403b plan. Well, actually, in reality, you're allowed to make $69,000 of contributions, and you can go beyond your 401k, 403b contributions if your plan allows it, and make after-tax contributions. And so you can the 69,000 includes your $23,000 401k, 403b pre-tax contributions or Roth contributions, and then your employer match, and then provided that your plan allows it, you can make after-tax contributions. Now, why would you want to do that? Well, the after-tax contributions can be distributed to your Roth IRA account. And so if you leave your employer allows an in-service distribution, you're of the right age, you can then move the money to a Roth IRA. So this is what we call a mega backdoor Roth IRA. And it allows over time potentially a huge amount of money to be saved in taxes, because the money in that Roth IRA account, it's tax exempt. You never have to pay taxes again. Let's move on to the next slide. So other ways of saving taxes. Well, where you house your investments, great opportunities, something we see missed often. Often we have different accounts that have our investments. We have retirement accounts. We have Roth retirement accounts. We have traditional retirement accounts. We have taxable brokerage accounts. We might have trusts. We talked about HSA accounts. You shouldn't prorate your investments between these accounts. You should think about which of these accounts makes sense for your investments. Some investments are very tax inefficient. They produce bad rates of tax, like ordinary income. Boo, that's the worst rate of tax. You have other investments that produce lower tax rates, like capital gains tax rates, like stocks. So the things that produce ordinary income often should go into your retirement accounts, and they get sheltered. And then things that are more growth oriented should go into accounts like a Roth IRA, which you want to grow as much as possible, because it produces a good tax benefit. And when you take the money out, you don't have to pay tax at that time. And also in your personal account, which you can benefit from if there are any losses. You make an investment that goes down in value, you can actually take advantage of those losses by selling the investment and using it to offset other income. Trusts are, if you have an irrevocable trust, that gets to the highest rate of tax very quickly, and you really have to think hard about what the goals of the trust are. And taxable bonds, for example, can often make poor sense in that type of account. Let's move on to the next slide. So, looking at your investment portfolio, there are ways to not pay taxes on your investments that are legal, that everything is legal and above board. And then there are ways of deferring your tax. Which work very similar to how a 401k works in terms of having a very favorable loan from the government that produces wealth over time. So the ways of eliminating tax: folding your investments into your charitable planning. Instead of giving cash, give appreciated stock. You get the deduction, you get the same value that's transferred to the nonprofit, and they sell it, and there's no tax owed. Then there's also, if you're making gifts to family members, often gift is made, but appreciated securities can be given instead, and then those people could potentially sell those appreciated securities at a much lower tax rate than you, potentially zero if they're in a low tax bracket. You don't have to pay capital gains tax until you get to more of a moderate income level. And then beyond eliminating tax, you can defer tax. And one way of deferring tax is by harvesting losses when they're available. Think about 2020, when the markets declined very quickly and very harshly, only to come back later that year. Well, if you took the losses that were available to you and sold your investments and realized those losses, and then not sat out of the market, but bought substitute investments that behave similarly, you would have this huge loss that you could then use and carry to offset income, and then carry forward into future years. That's the benefit of loss harvesting. It allows you to defer income and defer tax. And then let me switch gears in the interest of time and to estate and asset protection. I'll leave you with a couple of thoughts. Estate and asset protection, our physician clients like to think about protecting loved ones, and they get serious about it often when they have children. They want to make sure that there are guardians in place, that personal and property guardians for their children, and that loved ones don't, if that's not specified, the courts will make that decision for you, and you don't want loved ones to be fighting over who is going to be serving in that role. You want your intentions clear through your estate planning. A lot of our physician clients want to avoid probate, because probate can be more costly and can delay things. I just unfortunately had a client pass away a couple of weeks ago who had a revocable trust in place. That's one of the ways to avoid probate. And she passed away the next day. The co-trustee was was able to access the funds and make decisions. And that's the benefit of avoiding probate. There are other ways of avoiding probate, which I won't, in the interest of time, I won't talk about. But there are other ways of avoiding probate in addition to revocable trusts. If we went to the next slide, taxes. Well, aren't state taxes for the very wealthiest now? You have to have there are over 13.6 million per person. That's true, but unfortunately in New York State, we have something called the New York State cliff tax, which it applies at about $7 million of assets. And unlike the federal estate tax, it's not portable. So if you die without using it, then you lose it. So this is something that we often are working with our physician clients on, because they are getting to or projected to get to that level of wealth where they have to think about this tax, and this tax applies at $1. And so when it first applies slightly over this 6.94 million, then you owe immediately hundreds of thousands of dollars of tax. And also federally, the federal taxes is scheduled to be sunset and cut in half in 2026, so applying to more people. Our physician clients are often thinking about lawsuit protection planning, and there are ways of thinking about how best to protect your assets, in addition to insurance, to protect your assets from creditors. And so strategies like deciding if an asset should be in your name or in a spouse's name who might have less lawsuit risk. In New York, you're allowed to own your real estate tenants by the entirety, which provides additional protection if owned tenants by the entirety. And so if a creditor can't easily get access to that asset. And then sometimes trust makes sense and getting money out of your name. And we talked about estate planning, and it's a benefit, additional benefit of estate planning, and using trust can be also lawsuit protection planning. There are other assets that have greater lawsuit protection, like retirement accounts, and then insurance products as well can also offer greater lawsuit protection. Insurance is something that's on the mind of many of our physician clients, and I would say even more so than other clients we work with, particularly because of disability insurance planning. Sometimes we have physicians who are making money through more money through one activity, like let's say surgical procedures, and then if they get disabled and they can't perform those surgical procedures anymore, but they still can teach or do the rounds. Unfortunately, an insurance company may not consider the physician disabled. So that's a reason to take a close look at your policy and then consider whether there's a benefit to buying an individual policy that has greater protection. Beyond disability coverage, homeowner and auto and liability coverage, liability against lawsuits that might arise on the road, unfortunately getting into an accident or someone slipping and falling and looking at you as the deep pocket as a physician who they think they can sue and get money. You can protect yourself against those risks pretty cheaply through liability coverage and umbrella coverage. And then you can make sure that you don't have additional gaps in your homeowner and auto policies. Long-term care, as Jesse mentioned, something that gets more important as you get closer to retirement. For many, we help physicians decide whether that makes sense. And then life insurance, I had mentioned before, as a way to protect against risk of an often an early demise, and making sure there's money available to your loved ones. So I quickly took you through some important planning considerations in different areas and gave you some highlights. I'll now turn it back to Jesse.
Thanks, Andrew. Yeah, and in the interest of time, we know we're getting close to 7 o'clock here. We obviously a lot to cover through the physician's life cycle, and we do a lot of presentations. We usually do a webinar every month to the associations that we work with, to their membership, diving into each of these topics in a lot more detail. But we hope this was a really helpful overview of the life cycle that we often see with our physician clients, and certainly everyone is welcome welcome to also have a a free consultation with us if you're interested in speaking about any of the areas that we covered this evening, or if there's areas that we didn't cover that you're interested in. We want you to certainly be able to contact us and have a one-on-one conversation about your situation. So you can do that and have all of your questions answered. And but for now, and you can also, if you want to even take out your phone, you can schedule a time on the screen here to talk with us more personally. But would love to hear any questions that you all have. And once again, thank you so much for having us this evening.